99% of the time, we're only going to count when the rewards actually hit your wallet. It's very, very difficult to know what has been accumulated within the contract at a specific time to know, what that value is.
G'day everyone, and welcome back to another episode of Collective Shift. We have our tax specialist, Adrian Forza, today from Crypto Tax Australia, a long-time friend of mine, friend of Collective Shift. He's been a member for over 4 years and has been doing the nightmare job of helping a lot of Australia, in my case, a nightmare job of helping probably thousands and thousands by now, mate, crypto investors and traders with their tax. So thanks so much for the time, mate. I know you're busy.
No problem. Thanks, Ben. Thanks for having me on again. It's been a while since we've been on, but it's good. It's exciting coming up to the end of the year. Crypto's still going. We're not dead yet, like everyone keep pronounces. So hopefully 2023 is going to be a good year.
I agree, man. I agree. And again, thank you so much for your time. So quick overview of today's video. We're going to be covering the basics for Australian crypto investors, some common pitfalls, what you need to sort of be thinking about when getting into crypto and doing your tax, because if you're like me and leave it up to the last minute, it's an absolute nightmare. So I wouldn't recommend that. We're going to touch on some of those basic stuff. Then we're going to get into some education and tools. So we're going to think about how you can write off, for example, your Collective Shift membership. What are some of the online tools and platforms you can use, the pros and cons. We're going to talk about DeFi and staking. We're going to be talking about gaming, some NFT stuff, and some gifting crypto at the end. I'll timestamp the video below so you can skip to whichever part you're most interested in. There's a lot of questions. We'll try and get as many as we can as possible, but let's get into it. So if you're... Actually, let's just take a step back. I know you've been absolutely slammed over the last sort of few months. There's been a few people trying to get some tax services from, a range of different people in Australia. Give us just the lowdown of like the volumes you guys are seeing and just probably common response times and things like that for people that need some help.
Yeah, I think obviously, we've been doing this for over 4 years now, and the landscape's changed. Back in 2017, 18, it was all about, people using, 10, 15 exchanges, jumping on every ICO that was possible. And, that was, the tools back then weren't great at all. It was just Etherscan that was sort of in its sort of infancy. It's not as good as it is now, obviously. And then obviously fast forward to 2020, we had that DeFi craze with ETH coming out and BSC. And now, things are a lot more complicated. And I think people understand that now, where they're jumping from chain to chain, gaming, all these in-game transactions, NFT trading. It's not just on OpenSea anymore, and all the different chains that are available, BSC, AVAX, Phantom, Terra, Chronos. There's a new layer one coming out, every month, and people experimenting. So I think, for us personally, yes, the tools have gotten better, but it has become so much more complicated, and there's a lot more time that we need to spend to reconcile things properly. And unfortunately, that's just how it is, and that's how it's going to continue to be. A lot of the softwares are good, they're getting better, but they're never going to be perfect. They never will, because they will not be able to sustain and catch up to just the growth. There's a new project coming out every single day, and new protocols and new products and how they sort of interact with each other, and what happens on the blockchain through the contract. So there are times that we just can't get to clients straight away, just because of that. We want to help as many people as we can, but ultimately we also need to make sure that what we're doing and what we're preparing is correct. And sometimes, and I think people understand now that the number of transactions has gone up significantly, especially when you're using futures trading, or if you're using, very cheap chains like Polygon or even Phantom, when you're paying like 2 cents, a dollar, or you're using something like Zrun, and you're making bets every single day. Like the transactions just rack up. I think the most we've had is like 280,000 transactions or something like that. It was just ridiculous. And yeah, so look, that's reality, and I think a lot of accountants, even those that specialize in crypto, will understand that, because there's obviously a lot more people that have come in. We always talk about that in the 17-18 cycle. A lot more people came into the space, and then maybe 10% dropped off. And then this next cycle, when we started to run up from July 2020, a lot more people came in. Then we died off in May. Then we had that run up in November, and now the whole NFT craze and gaming craze is coming. And there's so many more people coming in, not just everyday sort of investors like me and you, but obviously institutions. And there's actually a lot of older generations that are actually getting into the space and learning about it, and using all these different tools as well. So, I think, I can't remember if it was the ABC or the Herald Sun, said something like there's 1 million crypto investors in Australia now. Yeah, it's just crazy. It's crazy.
And everyone needs to do their tax, right? So thank you for that rundown. I mean, what tips or just like basic fundamental things would you recommend all crypto investors do to make the end of financial year, or when it comes to doing tax, so much easier?
Yeah, I think being on top of what you're using and what you're doing. So I've said this in previous videos, where writing down all the exchanges that you use. I mean, it's a little bit different now. People don't use as many exchanges anymore, centralized exchanges, but noting down specifically all the wallets that you've used. Now, a lot of times what might happen is you might have a MetaMask, and then a few months later, you lose the key, or you start a new MetaMask, and you forget about it. But make sure you write that down, because come tax time a year later, your accountant's going to be asking, okay, well, where did all these transactions come from? And you'll say, oh, well, it was my old MetaMask. And if there's, I guess, things that you're doing or experimenting with, it's a new protocol or a new game, or that type of thing, note down maybe in a diary or a spreadsheet or something like that, to actually note down what you're actually doing. Because sometimes it is difficult to understand, on the on-chain transaction, what's actually happening. And a lot of time we'll go back to the client, and that might be a year later. Now they're not going to remember 2,500 transactions ago what they were doing on this specific game or whatever it might be. So just keeping a diary of, okay, I've played this game, I've used this protocol, I've used this layer 2, etc., and that'll really help, at the end of the year on what you've done, because I think people underestimate how much they actually do in a year, and they move coins from here to here, and you sort of get lost and you forget. So that's definitely just keeping a diary and noting down the wallet specifically of what you've done and what you've used.
And when you're looking and trying to do that on your own, so we had a few questions about people using things like Coinly, CoinMarketCap, not CoinMarketCap, Coin Tracker, a few other like the coin tax softwares. And we had a few members basically mention that they weren't lining up. There was like anomalies, and when you're talking thousands and thousands of transactions trying to do it on the software, what are the pros and cons of doing it on your own on a piece of software versus a service where you can talk to an accountant?
Yeah, I think obviously it's just an experience thing, right? So for us, 95% of our clients are in crypto, and they always have been for the last 4 years. So it's something that we do all day, every day. Whereas if you're actually doing it with by yourself, depending on depending on the what's the sorry about that. Depending on the complexity, it might actually be easy. So if you've just used one or two exchanges, in a wallet, and you just send stuff around, it'll be fine. Those softwares are good for basic, but when you start moving into very complex transactions, and you're using Zapper or DeFi Saver, or jumping between chains and chains, it can get difficult to track, and sometimes what will happen is some of the softwares will bring in the transaction different to what it probably should be. So a lot of the times clients will come to us and say, well, it's saying that I've got $1 million as a capital gain, but that can't be right, and there's something wrong. And when you're filtering through all of these transactions and not knowing what to look for, it can get difficult, and time consuming. So that's why, as I said, it's just an experience thing when you're going to someone that specializes.
Yeah, for me, I've always done my tax with fours, and for me, it's just a time thing as well. And I fucking hate numbers, So like, I think it's if you're good at that and you like your spreadsheets and you want to do it on your own, like that, absolutely go for it. And I think there is some great softwares and tools out there. But again, if it's like more of a complex situation, time thing, you have a bit of money on the sides that you're happy to pay for someone to do it. It's a great alternative. Fours, with education such as Collective Shift and or other education subscriptions people might have, Real Vision, Mazari, things like that, is that something that Australian investors can write off?
Yeah, they can. So, I mean, without getting it into being too tax technical, the majority of, there's this whole accounting, taxation around, revenue and capital. Now, if you're just a normal investor that has just bought and hold, the answer is probably not. But a lot more people are delving into DeFi staking, and they're earning a revenue, and they're earning interest and taking out loans and all that sort of stuff, and that falls in, I guess, the revenue classification. So the answer for I would say now, the majority for majority of people, it's yes. Maybe 3-4 years ago when it was just trading on spot, probably not, but I'd say yes for the majority of people. I'd say 90%. It's definitely something you can claim now, because it's allowing you the ability to earn income and staking income, which everyone's basically doing now, instead of just letting the coins sit on their wallet.
Yep. So if you are investing in education or research platforms like us, you can, for some of you, write that off, which is awesome. Now let's get into some of the topics.
Yeah. So just to understand how that works. So let's just say you put your money on BlockFi, for instance, or Celsius, and you're getting some interest revenue from the BTC or the ETH that you put in. And you've earned $1,000 of revenue from that, or interest. And the Collective Shift, let's say it's $100 for the subscription. Then that will bring down your total profit to 900, and you only pay tax on the 900, so it brings down your total profit.
That's awesome. Cool. Let's get into some of the topics. So we'll start with DeFi and staking. We've got a couple of questions that were sent in here for. So first one. What is the tax treatment of staking rewards? Is it only when it hits your wallet? And is this income or capital gains?
I'd find it surprising if anyone else differs, but in the answer. But generally, when you're staking, you've locked up a certain amount of coins. This is a typical scenario, and you're obviously getting coins as a reward for locking them up, for either validating transactions or whatever else. 99% of the time, we're only going to count when the rewards actually hit your wallet. It's very, very difficult to know, what has been accumulated, I guess, within the contract at a specific time to know, what that value is. So you could call it an accrued staking revenue, but again, at the end of the day, it's going to be hard to sort of prove what that value was. Again, it's more complicated. It takes more time. Depending on the value, if we're talking about hundreds of thousands of dollars, we might do that. But if we're talking about, $1,000, the time taken to go back and work out on a pro rata basis and all that sort of stuff, it's probably not worth it. So, I mean, sometimes I do say to clients, it is, I guess, a deferral mechanism. I've talked about things like Alchemix before, where it's a self-repaying loan. Now, you don't sort of really going to realize that until either the loan's paid out or you pull the money out. And there's various ones like that, like Yearn's very similar, and a lot of other protocols. So you can use it to your advantage. One thing I will say though is, yes, it is classed as revenue, so it is staking. Call it interest, which is sort of similar to what you'd put on your tax return. The issue is that, and I've said this a lot of times, and people still get caught out, is that especially at the start of the staking, if it's fresh, people are receiving staking rewards, and let's say you're getting $10 a day, and that's happening for a month, and by the end of it, you've got $300 of staking income. The issue is that because they're classed differently, one is a staking revenue, so you're going to get taxed on the $300 that you have earned. Now, if that coin now drops 90% in value and you sell it for $30, then you're going to make a capital loss. But the issue is that this revenue income can't offset the capital loss that you've made. So a lot of the times, and another instance is where you might have earned all of this staking revenue, held the coins. You get to the end of the financial year and you go, okay, well, I've made 10 grand on staking revenue, but now the coins are worth $1,000, and I'm going to have to pay tax on that 10 grand of staking revenue, even though I haven't really got the money in my pocket, or the value of that coin is 10 grand anymore. So you sort of shoot yourself in the foot from a tax perspective, and there's that risk there that you need to understand that risk. Some people are fine, they can take that hit, but when you start talking about larger numbers, it can make a really, really big difference, and especially if that happened during May or even November, when we're shooting at all-time highs, and now we've come down a lot further. Most people's portfolio will be down 30, 40, 50, 60%, 80%, whatever it is. You just got to be really mindful of that. So I always like to say to clients, at least take a little bit off the table, chuck it in a stable coin, 30%, something like that, to then at least cover yourself for the tax. And that's also your profit taking as well. Chuck it on Anchor for, I think it's about 17 now, percent, or Celsius, whatever it is, and at least get a yield, and leave it there to pay for the tax later on, because then you'll get caught out. So that it happens every year.
Yeah, that's a good point. And I think you're just quickly calculating 30%, whacking into stables, putting into cash, put in the bank account, whatever you want to do, just to store it for a rainy day, just so you get caught out. Especially if you're trying to earn staking on some of the more riskier altcoins,
That's
trying to
right.
earn a big yield or something like that.
And when the volatility is up and down, that's when you're really exposed. I mean, the other thing, some people are disciplined, which is great, but a lot of people don't actually cash out to Aussie dollars anymore, because they don't need to. I think once you're in crypto, you sort of stay in crypto. If you're going to cash out to Aussie dollars, what are you going to get at the bank? 0.1%. of nothing. It doesn't even cover inflation. Where if you can chuck it on something, it's on a lending platform, at least you're getting some sort of return on that. Now, if you don't want to be subject to the AUD USD exchange rate, they've got True AUD on crypto.com and in Celsius as well. So I can't remember what the rate is now. It keeps changing. Chuck it in there and, pull the money out. And that sort of comes back to what I've spoken about before about deferring the tax to, as late as possible, because if you can get a yield for 11 months and lodge your tax return in May, then you rather have that in your pocket than the ATOs.
Awesome, mate. That was great. So probably covered DeFi and staking pretty well there. Let's move on to gaming, play to earn gaming. We'll keep this quite broad because I think, as you mentioned before the call, that play to earn gaming is so broad and there's so many moving parts in different specific games. So we'll take a broad approach on just taxation on play to earn games. Yeah, I might just hand over you because the example one of the members sent here was about Magic and Bridge World. Do you just want to maybe give just maybe like a macro overview of just play to earn gaming and how that is treated as in tax?
Yeah, the issue is that all games are different and all games interact differently on the blockchain and off chain as well. Sometimes you can't actually see what's happened off chain unless you're the one that's actually signed into the wallet. So it is difficult to sort of know what's happened. I think what it comes these things will be flushed out over the next year or two, because realistically the gaming, Axie is probably the prime example that started taking off about a year ago. I think what people need to just keep in mind is, and it sort of crosses over with NFTs a little bit, but it comes back down to intention. Now, it is difficult to ascertain whether or not you're playing the game because you like playing the game, or because you're making money from it, or is it a combination of both? A lot of the time you got to be realistic about what is the potential. What are you actually making? Now, if a client's playing a game, and they're earning a couple of dollars a day or something like that, or they're experimenting, I wouldn't worry about it too much. It's just it's too small to sort of go through and really classify it as, you might classify it as income, or you might just leave it, as non-taxable. But when you start to, make a considerable amount of money, then you've got to look at, okay, well, what's the actual intention here? Now, legitimately, you might actually want to play the game. You wouldn't be playing the game if you didn't like it anyway. But obviously, with blockchain gaming and making money, I think it has moved to that now. I think the money aspect of blockchain gaming is sort of the first thing that people are looking at, instead of, is the game good? If you take Axie, for instance, if it wasn't attached to a blockchain, would it really be that popular? It's not really a great game. I'm sure there's other games that have done very similar games to that, but because Axie was on the blockchain and you can make money on it, and you can hold your actual NFT and all that sort of fungible discussion, then most of the time you're doing it to make money. And I think that's, people just need to think about what's the worst case scenario in this example. That, okay, I've started off, I've minted an NFT as part of a character in a game. It's making me, 10 magic a day, and you've got to, I guess you've got to look at how the mechanics of the game are working. So, for instance, Bridge World, there's no real how can I say you know strategy or interaction in that game. It's really about a click, send off a quest, get an item, sell it on the marketplace, upgrade. You're not really. It's not like a game that you're playing. It's more about collecting items to upgrade and make more money, if that makes sense. It's not like a World of Warcraft where you're going out with your character and all that sort of thing. Maybe when mainstream games comes in, it might change. I mean, Illuvium's a big one that's coming up now. The land sales in about a month's time. So, it's going to change. The short answer is, it just depends. Until some of these things go through the courts, it's hard to sort of really, I guess, clarify, and it's going to be on a case-by-case basis, to be honest.
Valid point. So I think it's taking the game case by case and, different games, different things. But for the Bridge World aspect there, and the volume you're doing as well, right? If it's a few dollars, it's probably not that much to worry about. But if you're doing it to actually earn an income, or it's decent amounts,
and you've got to think about how much money have I put into this game. Now, a normal game, that you go and buy might cost you $100. Would you pay $5,000 for virtual land that's going to give you rewards? Now, are you doing that to actually play the game? I probably wouldn't pay $5,000 for a game. It's my intention there is that I'm buying this land so I can make money from it. So that's where that psyche comes in about, am I putting capital up? Well, if I am, then my intention really is to make money, isn't it?
Are you going there for entertainment or to make money?
Yeah.
That's the question.
Yeah.
Let's move on to NFTs, which have obviously blown up the last couple of years. Let's talk about some rug pulls and just, the area of when you've lost money, whether that be through harvesting or just the project's gone to zero and they're worthless. Can you claim these as capital loss, or do you need to sell them, or how does that all work?
Yeah, I think if it's extremely clear that there's been a rug pull, or the project's gone missing, or whatever it is, then you could probably get away with claiming that as a capital loss without selling it. It's got to be pretty clear though. But if you've bought or minted an NFT for 1 ETH and now the minimum's 0.1 or 0.01 or whatever it is, it might still have a value there, because the problem is that a lot of these projects are hyped from the beginning, and everyone wants it at the start, and then they realize, okay, well, it's actually not that good, and people sell it down and try and flip it and all that sort of stuff, and then the game's not as good as we thought it was going to be, or the NFT is not as good as we thought it was. Now that might still have a value, because in a year's time or 2 years' time, that team might come back and go, well, we've added this, and this, and then the price shoots up again. So it might be a too early to call situation to write that off as a capital loss. So if you really wanted to cement the loss, you either have to sell it for nothing. Now the problem is it's going to cost you gas fees, or send it to a burn address, and hopefully one day that NFT is not worth something later on. Just like what's the first ones? What are they called? The first NFTs. What are they? Not Bored Apes. Can't remember.
Oh, the punks.
Crypto punks. Yeah.
Mate, so just on that was a follow-up question as well around what happens if we claim a loss, and the asset is impaired, but then in 3 months' time it's suddenly worth 10x and liquid again. What we're saying is that unless it's ultra clear that that project is never coming back, you can't claim that loss. You always need to, in most cases, 99% of the time, sell that asset, sell that NFT for something or nothing to lock in that loss.
Yeah, I mean, it is a hard one because, it's not as liquid as just buying Bitcoin on an exchange. So it might take you a week, it might take you a month to sell that. That's why tax planning now around, if you want to get rid of your NFTs, you might put it on the market, now to sell it at a loss prior to the end of the financial year. And if not, you probably got some homework for the last week of June to flick them off to a burn address.
Forz, what about the wallets that receive like fake scam tokens? Some members here have saying they've got a lot of random NFTs that could be legit airdrops, but some of them are scams. Is it our obligation to check every one of them and justify if they have no value? Or
99% of these airdrops are just, valueless. The ATO's got a ruling around classifying airdrops as income. I don't know if that's entirely correct. I don't really agree with it. So I would just use a judgment call in terms of, you would see on your wallet whether or not these scam tokens are actually worth something. Now, if they are, fantastic. Or if they're actually a legitimate airdrop, great. I remember when the uni drop came out, and I think a lot of people were like, "Oh, is this a scam? What's going on here?" And then everyone got it and they dumped their tokens, and then I think about a couple of weeks later, it just shot up again. So yeah, I think just use some common sense around. Well, is it worth something? No, then just leave it alone. And I think people have got to be wary that sometimes with these scam tokens, I know there was one with Rune, I think, for an NFT or some sort of token for Rune where if you clicked on and interacted with the contract and signed something, it would basically scrape all of your NFTs out of your wallet. So you just got to be careful not to even interact with them. Sometimes check on CoinGecko, Etherscan, that type of thing. Sometimes Etherscan will say that it's some sort of scam project.
Forz, anything else in the NFT space that we didn't touch on there that you get common questions about, or common problems that could be some advice for those NFT investors?
There's been a lot of clients who have made a lot of money this year in terms of flipping, staying up till 3 a.m. in the morning to mint and all that sort of thing. I think obviously be wary of what you're getting into. Just because your mate made 10 grand last night doesn't mean that you're going to. There's a lot of crap out there. But planning in terms of end of financial year is always key, like we talked about before. And with the NFTs as well, they're still an asset for capital gains purposes. So if you do hold them for over a 12-month period, you'll still get a discount, just like you would normally. So keep that in mind. If you got your Bored Ape, that seems fairly promising with what's going on with that. Might be a good idea to keep that one around. But I'd say the majority of people are just buying, flipping, and just be wary that if you're buying and selling and flipping into ETH, again, if ETH's at 3,000 today, and in 6 months' time it's worth $500, I don't think it will be, but you're still going to owe tax on that profit that you've made. And I've said this so many times to clients, just take some profits off the table. Yes, you might miss out on extra income, but 80% of the time when I talk to clients, it's always, I should have taken money, I should have taken profit, I should have sold. And it just comes down to greed and experience. And I think looking at the people that did make money over the 2021 period were older clients or those that had been in the system for a while and went through that 17, 18 peak where their account went from 10 grand to $500,000 and they never took the money out. And then they stuck around, dollar cost averaged, and then they go, okay, well, shit, this time we're going even crazier. I'm going to take some money off the table. And they did. They're happy. Could they have made more money? Yes, you can always make more money. But it's a dangerous game to keep reinvesting, especially because of the tax implications. So, it's fine to reinvest, part of the profit, half if you really want to. You've got to work out a strategy that suits you, but always take at least some off the table into a stable coin at least, and you don't get any big surprises because the issue is, when good times are rolling, everyone's happy, and people are making money, but we go through these cycles. How many times does it happen? It's up and down, up and down, up and down, and you're never going to catch the bottom. You're never going to catch the top. So it's always something in the middle, but you've got to be happy. And I think one thing I've definitely learned is, when you think you're a genius, it's time to sell. Because, and that's happened to me, personally, where, there was a time, even in November of last year, when things were going crazy again, and I sort of thought to myself, and I said, I'm acting like this, and I think it's maybe time to pull some profits out because I realized my own euphoria. Everyone gets that. Everyone gets FOMO, when they're seeing their coin going up, 20%, 30%, 50%, 200%, in a week, and going, geez, just like the old boys that said, maybe Ripple will get to $10,000 a coin, all that sort of stuff. Yeah, it's crypto for you. I love it. It's great.
Yeah, when it gets to that point where you're sharing, your wins to your friends and family, and sort of bragging about those profits, it's usually time to reconsider.
Yeah, I mean that's what you guys teach all the time anyway too, and I think you guys have been harping on about that always. I think, yeah, it's just a cycle you need to go through sometimes, and realize yourself and go, I'm not going to make this mistake next time, and not getting greedy because you'll never ever ever pick the top. Maybe once you might for one coin, but you won't be consistent. It's just not possible.
And when you get ahead of yourself, what's the saying? A turkey can fly in a hurricane. I've definitely called out to be a turkey sometimes, getting too ahead of myself. So yeah,
I think everyone has. Everyone, everyone's gone through that stage, and I think you have to, someone can tell you a million times, but unless you've actually gone through it and you've gone through that pain, that's how you learn. And people still got caught out in 2021 where they didn't take any profits off the table, and now where are we? So yeah, it's part of crypto. It's the highs and lows all the time, isn't it? Some days we're cheering, some days we're going, oh geez, Bitcoin just crashed 10%. So
Forza, thank you so much, mate. That's been super helpful for a lot of us that probably avoid tax in the last minute, and I think a lot of good takeaways there to prepare ahead of time. And the NFTs, DeFi, and staking, and all the new sectors that are popping up, I can understand your job can be pretty difficult. So thank you so much for your time, mate. Where can people find you if they're wanting to, just go Forza? Can you just help me out?
Yeah. So jump on our website. I think we've got links on your website and app and Discord as well. Yeah, either phone call, email, and you can get in touch, have a look at our website. New financial year's coming up into play. It's always a good idea to get on the list of a tax agent. So you got that extension till May. Always happy to help.
Brilliant. And I'll drop those links below. I think the end of tax, when's it due? Did we say Forza? When are the due dates in Australia? So it's basically you get the extension up until now if you're part of a tax agent.
Yeah. So if you're with a tax agent, and you've had all your obligations up to date, then you usually get an extension to about the 15th of May the following year. So for this tax year that we're finishing in 8 weeks' time, the 2022 year, you get an extension until May 2023. If you do it by yourself, then you get until the 31st of October 2022. Now, there's always, ways that you can extend it even further. Even if you did, at this present time, we're lodging returns in the next couple of weeks for clients. Now, if they want to go on a payment plan, that's fine. We can extend that out to 12, 24 months, and they can pay it over a certain period and still earn and keep some of their assets in crypto without, having to sell down.
I need to get mine done because I haven't done mine either, so I'll probably be sending you a message after this, mate. Thank you so much for your time again, Force.
No worries, bud. Thanks a lot.
Cheers, guys.
See you, Ben.